April 1999. A company goes public at a valuation of $10.5 billion. Within 2 years, it's worth $35 billion. Within 4 years, it's bankrupt. The company is called Excite-A-Home. It was founded by Stanford professors with PhDs in computer science. Backed by Kleiner Perkins, the most prestigious venture capital firm in Silicon Valley. Partnered with Comcast and AT&T, two of the largest companies in America. Everyone involved was smart. Not just smart, brilliant. These were people who had built billion-dollar companies before, who had PhDs from Stanford and MIT, who managed hundreds of billions of dollars in assets. And they all got it wrong. This is the story of why intelligence doesn't protect you from bubbles, why being smart can actually make you more vulnerable, and why the most dangerous ideas are the ones that make perfect logical sense. Because the scariest part about Excite-A-Home isn't that it failed. It's that if you heard the pitch in 1999, you would have invested too. 1995, Stanford University. 3 computer science researchers are working on a problem. The internet is slow, painfully slow. Most people connect through phone lines at 28.8 kilobits per second. The 3 researchers are Parviz Yagani, Ajay Srivastava, and Mark Jennings. They have PhDs. They understand networks at a fundamental level. They're not entrepreneurs looking to get rich. They're engineers solving a technical problem. Here's what they figure out. Cable television lines can carry data much faster than phone lines. 100 times faster. Maybe more. If you could send internet data through cable lines, you could make the internet fast. Really fast. This isn't a crazy idea. It's good engineering. Cable companies have infrastructure in millions of homes. That infrastructure is mostly idle. It only carries TV signals. You could use the same wires to carry internet data. The technology works. They prove it in the lab. Now they need to commercialize it. And this is where the smart people start to arrive. 1996. Kleiner Perkins invests. This isn't just any VC firm. This is the VC firm. They backed Amazon. They backed Netscape. They backed Google. John Doerr, the lead partner, is considered the smartest investor in Silicon Valley. When Kleiner Perkins invests, everyone pays attention. Next, the cable companies arrive. Comcast invests. AT&T invests. Cox Communications invests. These aren't startups. These are massive corporations with billions in revenue and millions of customers. Here's why they invest. They already have cables running to homes. The marginal cost of adding internet service is low. They can charge $50 per month for high-speed internet. The profit margins are enormous. Let's do the math. Installing cable internet costs about $300 per customer. Monthly revenue is $50. Profit is maybe $30 after costs. That's 10 months to break even. After that, it's pure profit. By 1997, Excite-A-Home has $30 million in funding, the best VCs in the world, partnerships with the largest cable companies in America, technology that works. Then something unusual happens. They merge with a search engine called Excite. This is odd. Cable internet and search engines aren't related businesses. Why merge? Here's the thinking. If you control the pipe into people's homes, you can control what they see. Fast internet plus a popular search engine equals a dominant position in the market. The merged company is now run by George Bell. He's the CEO of Excite. He went to Dartmouth, worked at Times Mirror. He's experienced, articulate, and convincing. In interviews, Bell talks about convergence, about how the internet and television will merge, about how Excite-A-Home will be the gateway to this new world. He's charismatic. He believes what he's saying. And when you listen to him, you believe it too. April 1999. Excite-A-Home goes public. The opening price values the company at $10.5 billion. The company has $79 million in revenue. It's losing $300 million per year. That's a price-to-sales ratio of 133. For context, profitable companies typically trade at ratios of 2 or 3, maybe 5 if they're growing fast. So why did smart investors value Excitehome at $10.5 billion? Because they were looking at different numbers that made perfect sense. Let's examine the logic. Excitehome had 300,000 subscribers in early 1999. They were adding 50,000 subscribers per quarter. That's explosive growth. Project that growth forward. In 2 years, they'd have 3 million subscribers, each paying $50 per month. That's $1.8 billion in annual revenue from cable internet alone. Add the advertising revenue from Excite's search engine. Add the e-commerce partnerships. Add the content deals. You could easily project $5 billion in revenue by 2002. $5 billion in revenue. Apply a price-to-sales ratio of 5. That's $25 billion. At $10.5 billion, the stock looks cheap. The math worked. The logic was sound. The team was brilliant. The technology was real. Every single assumption seemed reasonable, and almost every assumption was wrong. Let's examine why the Excitehome story seemed so logical, because this is crucial. The company didn't fail because the idea was stupid. It failed despite the idea being smart. Here's the thesis. The internet is becoming essential. People will pay for faster internet. Cable companies have infrastructure that can deliver speed. Therefore, cable internet will be huge. Each part of this thesis was correct. The internet was becoming essential. People did want faster internet. Cable infrastructure could deliver speed. The logic chain was valid. Here's why smart investors believed in Excitehome. The company had something rare, a structural advantage. Cable companies had physical infrastructure. You can't easily replicate millions of miles of cable. Compare this to other .com companies. Pets.com. Anyone could sell pet food online. Webvan. Anyone could deliver groceries. E-toys. Anyone could sell toys. But cable internet required infrastructure. That's a real barrier to entry. That's a real competitive advantage. Plus, Excitehome had partnerships with companies that owned the infrastructure. Comcast, AT&T, Cox. These companies reached 70 million homes. That's enormous distribution. Here's how it was supposed to work. Comcast customer calls and says they want faster internet. Comcast offers Excitehome service. Customer pays $50 per month. Excitehome gets $30. Comcast gets $20. Everyone wins. Better yet, this business had network effects. More subscribers meant more data about user behavior. More data meant better search results. Better search meant more users. More users meant more valuable advertising. This is the kind of virtuous cycle that creates lasting value. Amazon has it. Google has it. Facebook has it. Why wouldn't Excitehome have it? The timing seemed perfect too. 1999, internet usage was exploding. E-commerce was growing at 200% per year. Advertising was moving online. Anyone who controlled access to the internet would capture enormous value. Imagine you're an analyst at Morgan Stanley in 1999. You're evaluating Excitehome. You see brilliant founders, top-tier investors, major corporate partners, real technology, explosive growth, a logical business model. What's your recommendation? Every major analyst rated Excitehome a buy, not just hold, not just outperform, strong buy. Multiple firms had price targets of $100 per share. Some went as high as $200, and for a while, they looked smart. The stock went from $48 at IPO to $98 by January 2000. The company was worth $35 billion. George Bell was featured in Fortune magazine. Businessweek did a cover story. The Wall Street Journal wrote about the future of internet access. Every article assumed Excite-A-Home would dominate. Here's what's fascinating. At $35 billion, nobody questioned the valuation. When everyone agrees something is valuable, questioning it feels naive. It's like the emperor's new clothes. If everyone says they see the clothes, saying you don't see them makes you look stupid, not insightful. This is called social proof. Humans assume that if everyone else believes something, it's probably true. The more people who believe, the stronger the signal. And when everyone includes Stanford PhDs and Kleiner Perkins and AT&T, questioning that consensus requires extraordinary confidence. But social proof doesn't make something true. It just makes it feel true. And feeling true is enough to drive valuations to absurd levels. By early 2000, Excite-A-Home was still losing money. Revenue was growing, but costs were growing faster. The company needed to raise more capital, and the market was about to change. Let's talk about what smart people missed, because they did miss things. Obvious things in retrospect. Things that should have been visible at the time. Remember the simple transaction math? Install costs $300. Customer pays $50 per month. Profit is $30 per month. Break even in 10 months. That math assumed customers stayed for years. The average customer stayed for 18 months, not years. 18 months. Installation, $300. Monthly profit, $30 times 18 months equals $540. Total profit per customer, $240. That's not bad, but it's not spectacular, and it assumes perfect execution. No technical problems, no customer service issues, no competition. Here's what nobody anticipated. When AT&T invested in Excite-A-Home, they thought they'd profit from both sides. They'd make money as a partner. They'd make money selling the service. But offering Excite-A-Home meant AT&T was competing with their own dial-up internet service, the high-margin dial-up service that didn't require major infrastructure investment. AT&T's salespeople had quotas. Should they sell the customer dial-up or cable internet? Dial-up was easier to install, had higher margins, caused fewer technical problems. Cable internet was harder, required installation appointments, had more technical issues, and made less profit for AT&T. Salesperson gets a commission either way. Which do you think they pushed? The easier product with fewer problems. Dial-up. Everyone assumed cable internet had a monopoly. Cable companies controlled the physical infrastructure. Therefore, they controlled high-speed internet access. Except DSL existed. Phone companies could deliver high-speed internet through existing phone lines. Not as fast as cable, but fast enough. And phone companies reached every home in America. Plus, satellite internet was coming. Wireless broadband was coming. The monopoly wasn't a monopoly. Remember the merger between the cable internet service and the Excite search engine? That was supposed to create synergies. It created nothing. Cable internet customers didn't care about search engines. They used whatever search engine they wanted. The merger combined two businesses with zero overlap. George Bell defended the strategy in interviews. He talked about integrated platforms, about controlling the user experience, about vertical integration. It sounded smart. It was the kind of thing MBAs learn in business school. It just didn't work. Everyone believed that scale would improve economics. More subscribers meant lower costs per subscriber. That's how most businesses work. Cable internet was different. Each new subscriber required physical installation, required local support, required technical troubleshooting. Costs didn't decline with scale. They stayed constant. At 100,000 subscribers, cost per subscriber was X. At 1 million subscribers, Cost per subscriber was still X, maybe slightly lower from bulk purchasing, but not dramatically lower. The company was burning through cash. In 2000, they spent $800 million more than they made. That's $67 million per month. At that rate, they'd run out of money in less than 2 years. They needed to raise more capital. Easy, right? The market loved ExcityHome. The stock was trading at $70. They could sell more shares. Except, the market was about to close. March 2000. The Nasdaq peaked. Then it started falling. By December, it was down 50%. Raising capital suddenly became difficult. This is called the commitment bias. The more you invest in something, the harder it becomes to admit it's not working. You've already invested millions, hundreds of millions, billions. Admitting failure means admitting you were wrong, that all those smart people were wrong, that all that money was wasted. So instead, you invest more. You believe harder. You convince yourself the problems are temporary, that the strategy just needs time to work. By late 2000, George Bell was still optimistic in public, still talking about the future of convergence, still projecting profitability in 2 years. In private, board meetings were tense, executives were worried, but nobody wanted to be the one to say the emperor had no clothes. January 2001, ExcityHome stock is at $15, down from the $98 peak. The company is still losing millions per month, and the partnerships are falling apart. AT&T doesn't want to be just a partner anymore. They want to own ExcityHome. Or they want out. They're not interested in the middle ground. Comcast has the same concerns. They invested billions. They're not seeing returns. They're questioning whether they need ExcityHome at all. AT&T offers to buy ExcityHome for $1 per share. $1. The stock peaked at $98. Now the company's largest partner thinks it's worth $1. ExcityHome rejects the offer. They think they can survive. They think profitability is close. They think the market will recover. Here's what happens in a death spiral. Customers worry about the company's stability. Some cancel service. Revenue drops. That makes the financial situation worse. More customers cancel. Revenue drops further. March 2001, stock at $12. June 2001, stock at $6. September 2001, stock at 74 cents. October 1st, 2001. ExcityHome files for bankruptcy. The company has 3.6 million subscribers, $48 million in cash, and $6.7 billion in debt. Peak market cap, $35 billion. Bankruptcy value, 0. Total value destroyed, $35 billion. Employees who got stock options, worthless. Investors who bought at $90, lost everything. The venture capitalists, Kleiner Perkins lost their entire investment. Even the smartest investors in Silicon Valley got it completely wrong. AT&T bought the customer base out of bankruptcy for $307 million. Not billion. Million. That's $85 per subscriber. Less than 2 months of revenue per customer. The Excite search engine was sold separately for $10 million. The company that was once worth billions was carved up and sold for parts. George Bell resigned in May 2001. He'd done everything he could. Raised capital, cut costs, renegotiated partnerships. Nothing worked. The Stanford PhDs who founded the company, they'd already left. They'd sold some stock at the peak. They were fine financially, but their company was gone. Kleiner Perkins wrote off the investment. John Doerr, the legendary investor, had to explain to his limited partners how he lost hundreds of millions on what seemed like a sure thing. AT&T wrote off $2 billion. Comcast wrote off $1.5 billion. These weren't small amounts. These were material losses for major corporations. How did everyone get it so wrong? These were smart people, experienced people, people who had succeeded many times before. Because intelligence doesn't protect you from cognitive biases. If anything, intelligence makes you more vulnerable. You're better at constructing logical arguments, better at rationalizing, better at convincing yourself and others. Here's the uncomfortable truth about bubbles. Smart people are often more vulnerable than average people. Because smart people are good at building logical frameworks, they take assumptions and construct convincing arguments. The more intelligent you are, the more convincing your logic becomes. But logic built on false assumptions leads to false conclusions. And being smart doesn't help you identify false assumptions, especially when everyone around you shares the same assumptions. Excite Home had brilliant founders, top-tier investors, major corporate partners, real technology, a logical strategy, explosive growth. Every box was checked, and it still failed. Spectacularly. The lesson isn't that smart people are foolish. The lesson is that bubbles are created by smart people convincing each other of logical ideas built on flawed assumptions. Today, we see the same patterns. Brilliant founders, prestigious investors, compelling logic, explosive growth. Assumptions that seem reasonable but might not be true. How do you know if you're in a bubble? You can't. That's the nature of bubbles. When you're inside one, the logic feels airtight. The assumptions feel reasonable. The smart people around you all agree. Excite Home went from 0 to 35 billion to 0 in 6 years. It was founded by Stanford PhDs, backed by Kleiner Perkins, partnered with AT&T and Comcast. Everyone involved was smart. Everyone involved got it wrong. Intelligence is not enough. Logic is not enough. Sometimes the smartest thing is admitting you don't know, and the hardest thing is questioning assumptions when everyone else is certain. Excite Home, founded by Stanford PhDs, backed by Kleiner Perkins, partnered with AT&T. Peak valuation, $35 billion. Bankruptcy, October 2001. Sometimes the most dangerous ideas are the ones that make perfect sense.